Inside a pharmaceutical contract development and manufacturing organization, millions of units, creams, ointments, and gels move across the production floor every month. Behind this physical motion is a constant, invisible battle between four core departments. The commercial team promises rapid turnarounds to secure growth. Operations demands stable, predictable schedules to keep labor and machines utilized. Supply chain strips away raw material inventory to minimize exposure, and finance expects consistent EBITDA growth. These mandates actively conflict. Mandating a tightly managed make-to-ship environment forces supply chain to lower inventory levels, which immediately strips operations of its buffer against unexpected commercial changes. A traditional reporting dashboard will log the resulting inefficiencies at the end of the month. It passively records the damage. It does not calculate a way out of the current operational conflict. Resolving this tension requires abandoning static reporting in favor of an active, computable economic decision model. By connecting the commercial pipeline, manufacturing constraints, and financial targets into a single logic system, management can quantify the exact trade-offs of any decision across all departments simultaneously. We are going to build this model from the ground up, starting with the baseline unit economics of a single product. Because enterprise value is generated when the physical reality of the factory floor is mathematically welded to the financial ledger. Before a single machine turns on, we establish standard costing. This is the financial expectation of what a manufacturing run should cost, acting as the baseline against which all physical variations will be measured. This ledger visualization breaks down the standard cost for one batch of 1% hydrocortisone cream. We have $4,500 in active pharmaceutical ingredients, $17,500 in packaging, nearly $3,000 in labor, and $2,350 in overhead. The total standard cost sits at exactly $27,330. The first three expenses are relatively direct. The final variable, overhead absorption, is highly volatile. Overhead includes fixed costs like rent, utilities, and depreciation. If the facility carries $7 million in fixed overhead, and we plan to run machines for 140,000 hours, the factory must absorb $50 of overhead per hour. If the physical floor fails to meet those planned runtime hours due to setup delays or idle machines, that fixed overhead remains unabsorbed, pulling directly from the company's bottom line. To understand why those hours are missed, we have to examine the physical reality of compounding and filling viscous, semi-solid products. This physical routing chart illustrates the operational sequence. Raw materials are dispensed, moved into mixing vessels, transferred to holding tanks, pumped through the tube filling lines, boxed in packaging, and finally cleared by quality assurance. Within this sequence, the equipment and labor requirements at the filling and packaging stages consistently create physical choke points. When resources are constrained, total batch revenue is misleading. The only metric that accurately reflects production efficiency is contribution margin per bottleneck hour. If a specific product batch generates $64,270 in margin, but requires 16 hours on a constrained packaging line, the yield is exactly $4,017 per bottleneck hour. Pushing high-volume products through the factory is counterproductive if those items consume disproportionate time on constrained lines. Profitability is dictated entirely by how you schedule the bottleneck. Here is where the mathematical models collide with commercial reality. Clients routinely demand short-notice schedule flexibility, which severely impacts a make-to-ship facility operating with low inventory buffers. Consider an original production schedule built around a run of 100,000 over-the-counter lotion bottles. Midway through the week, the commercial team receives an urgent request and swaps the lotion for 60,000 units of a prescription ointment with a significantly slower filling speed. The physical friction of this switch is immediate. Tearing down the line for a different viscosity requires 8 additional cleaning hours. The scheduling gap leaves technicians waiting, resulting in 60 hours of idle labor. Those lost hours mean the machines aren't running. The facility immediately sheds $18,000 in lost overhead absorption. Factoring in the overtime and the idle time, this single schedule change results in a $34,000 hit to the EBITDA. Slashing working capital and holding low inventory does improve short-term cash flow, but without a buffer, every minor commercial shift creates an operational shockwave that actively destroys EBITDA. Managing these cascading, multi-departmental impacts in real time requires specific technological infrastructure. This three-part data architecture map visualizes the necessary inputs on the left. Operational actuals, routings, and material costs are pulled directly from the SAP system. Weighted future revenues and launch dates are pulled from the Salesforce pipeline. These disparate datasets feed into the central processing layer, a Python optimization engine utilizing libraries like ORtools and Pulp. The Python engine's objective function is mathematically clear: maximize EBITDA. It runs thousands of scenario simulations, testing different production schedules against strict limits on packaging time, labor availability, and working capital caps. The engine outputs to a final presentation layer built on a Power BI star schema. Central fact tables tracking variances and labor connect to dimension tables categorizing product lines and customers, providing a highly organized structure for end-user analysis. This architecture takes a company out of a reactive data warehouse and places them inside a proactive, predictive simulation. Once the physical plant is quantified, executive leadership can apply this system to long-term strategic positioning. Some bids do not present strong immediate unit economics, but offer intrinsic enterprise value that a standard balance sheet misses entirely. This weighted strategic scorecard matrix demonstrates how a partnership with a client like Pfizer is evaluated holistically. The model weights EBITDA at 30%, free cash flow at 20%, and working capital at 15%, while factoring in brand prestige at an additional 15%. Market credibility, platform validation, and the ability to attract future pipelines are assigned mathematical weight to offset the short-term margin pressures of onboarding a demanding client. True decision intelligence allows leadership to objectively price the value of market prestige against the physical strain it puts on the factory floor. This integrated data allows for highly reliable, driver-based forecasting. This long-term table maps out growth through 2030, charting revenue scaling to $30 million alongside corresponding increases in EBITDA and working capital. The accuracy of these projections relies entirely on tracking pipeline conversion rates against validated packaging capacity. When the entire organization operates from the same economic model, the friction between sales, finance, and operations dissolves. Enterprise value is created by achieving absolute mathematical equilibrium between capital constraints, operational risk, and